Hey there, aspiring investors. Picture this, you've got $100 burning a hole in your pocket, and you're ready to make it work for you online, all from the comfort of your laptop. Maybe you're dreaming of building wealth, or just curious about dipping your toes into the world of investing. Either way, you're in the right place. As someone who's been investing for years and has built a substantial portfolio, I get asked all the time, what's the best way for a beginner to start investing with just $100? To answer that, 4 years ago, I took $100 and spread it across 5 different investments to see how they perform. Today, I'm diving into those results to help you figure out which option might be the best fit for you. We'll look at each one through 5 key lenses: how easy it is to learn, how much passive income it can generate, how tax-friendly it is, how risky it is, and of course, how much that $100 is worth now. Before we dive in, a quick disclaimer: I'm not a financial advisor. I'm just sharing my own experiences and results. Always do your own research, as investing comes with risks, and what worked for me might not work for everyone. Ready? Let's jump in with some upbeat energy and see where your $100 can take you. First up, let's talk about investing in individual stocks. This is where you buy a small piece of a company you believe in, like Tesla, Amazon, or even a smaller up-and-coming business. It's thrilling because you're betting on a company's future success, and if they soar, so does your investment. But how easy is it to get started? Honestly, it's got a steep learning curve. Picking winning stocks isn't about guessing or following hot tips from social media. To do it right, you need to dive deep into a company's financial health. Think income statements, balance sheets, and cash flow reports. You'll also want to research the leadership team, the company's brand strength, and its place in the market. For example, when I invest in a stock, I'm looking at it as a long-term commitment, typically holding for 2 to 10 years. If you're new, a great way to practice is by using an investing app with a demo account. These let you trade with virtual money so you can test your strategies without risking real cash. It takes time to get comfortable, but once you do, it's rewarding. Now, what about earning money without selling your stocks? This is where passive income comes in, and stocks can be pretty good here. There are 2 ways to make money with stocks. 1, the stock price goes up and you sell for a profit. 2, you earn dividends. Dividends are payments some companies make to shareholders, usually every quarter, as a share of their profits. Not every stock pays dividends, but those that do, like big, stable companies, can provide a steady stream of cash without you lifting a finger. That's the definition of passive income, and it's a big plus for stock investors. When it comes to taxes, stocks can be a solid choice if you use the right accounts. In the UK, you can invest through a stocks and shares ISA, which acts like a tax shield, keeping your profits and dividends safe from the taxman. In the US, a Roth IRA offers similar benefits, letting your investments grow tax-free under certain conditions. These accounts can save you a lot over time, but tax rules vary by country and personal situation, so double-check what applies to you. I'm not a tax expert, so consider consulting one to maximize your benefits. But let's talk about the elephant in the room: risk. Investing in individual stocks is high risk. The market can be a roller coaster, and if you pick the wrong company, you could lose big. Back in the 1990s, during the dot-com boom, I got lucky with a few stock picks and made a nice profit. But when the bubble burst, some of my cheaper investments in smaller companies went to zero. Even though I came out ahead overall, it showed me how dangerous it can be to put all your eggs in 1 or 2 baskets. Diversifying, spreading your money across multiple stocks helps, but the risk remains high compared to other options. So how did my $100 investment in a single stock fare over 4 years? To keep things random, I imagined throwing a dart at a board with 20 stocks and landed on Samsung. That $100 is now worth $67.66, plus 10 cents in dividends, for a total of $67.76. That's a loss of 32.34%. Ouch. But here's the thing. That dart could have hit Apple, where $100 would now be $170, or Microsoft, worth $188, or even Nvidia, which skyrocketed to $908. This shows how stock picking can be a gamble. Success depends on research and strategy, not luck, and even then, the market can be unpredictable. For beginners, individual stocks are exciting but require serious homework. Next, let's explore real estate investment trusts, or REITs. If individual stocks feel like a high-stakes game, REITs are a bit more grounded. Imagine pooling your $100 with thousands of others to buy a big property, like an office building or shopping mall, and then sharing the rental income. That's a REIT in a nutshell. You're investing in real estate without the hassle of owning property yourself. It's like owning a tiny piece of a skyscraper or a strip mall, and it's all managed for you. Getting started with REITs isn't too tough, so I'd rate the learning curve as moderate. You don't need a massive down payment or a realtor like you would for buying a house. Instead, you can buy shares in a REIT through most investing apps, just like a stock. But you do need to understand what you're investing in. REITs own all kinds of properties, apartments, hotels, warehouses, and their income comes from rent. Researching which REITs focus on stable, in-demand properties is key, but it's less intense than analyzing a single company's financials. Passive income is where REITs shine. They're required by law to distribute at least 90% of their profits to investors as dividends, so you can expect regular payouts. Since many commercial properties have long-term leases, the income is often stable, making REITs a favorite for those seeking reliable cash flow. Of course, your returns depend on the REIT's performance and the types of properties it owns, but the potential for steady dividends is a big draw. Tax-wise, REITs are a strong contender. In the UK, you can hold them in a stocks and shares ISA, meaning your dividends and profits are tax-free. In the US, similar accounts like Roth IRAs offer tax advantages. These benefits can make a big difference over time, especially if you're reinvesting those dividends. As always, check local tax rules as they can vary. Risk-wise, I'd call REITs medium. They're safer than individual stocks because they diversify across multiple properties, reducing the impact if one struggles. But they're not bulletproof. If the real estate market slumps or tenants can't pay rent like during the pandemic, your dividends and investment value could dip. It's less volatile than stocks, but not risk-free. So what's my $100 REIT investment worth now? 4 years ago, I used a platform like Trading 212 to invest in a REIT focused on commercial real estate. Today, it's worth $98.59, a slight loss of 1.41%. But thanks to $11.93 in dividends, my total return is $110.52, up 10.52%. This shows REITs can be stable but aren't immune to market challenges, like the pandemic's impact on commercial properties. For beginners, REITs offer a nice mix of income and accessibility. Now let's dive into something a bit wilder, cryptocurrency. Think of crypto as digital money like Bitcoin or Ethereum that's not controlled by banks or governments. It runs on blockchain technology, which makes it secure and transparent. Crypto has made millionaires, with Bitcoin being the top-performing asset of the past decade. But it's also a wild ride, with prices swinging dramatically, so it's part investment, part speculation. The learning curve for crypto is moderate. It sounds complex, but it's manageable once you break it down. First, you need a wallet to store your crypto, either an online wallet, easy but needs strong security, or an offline hardware wallet, safer but pricier. Then, you choose an exchange, like Coinbase or Binance, to buy and sell coins. Finally, you should understand tokenomics, how a coin's supply and demand affect its value. For example, Bitcoin's limited supply makes it like digital gold. It's not as intense as stock analysis, but there's a learning curve to navigate safely. Passive income with crypto is moderate, but it's different from stocks or REITs. Crypto doesn't pay dividends, but you can earn through staking, locking up coins like Ethereum to support the network, and earn rewards or yield farming, where you lend your crypto for interest. Both can generate income, but they're riskier. If the coin's value crashes or the platform gets hacked, you could lose big. I stick to holding Bitcoin and Ethereum in a secure hardware wallet to avoid these risks. Taxes are a weak point for crypto. In many countries, every trade, even swapping one coin for another, is taxable, and staking rewards are taxed as income. Plus, you can't hold crypto in tax-advantaged accounts like ISAs or Roth IRAs, so you're more exposed to taxes. This makes crypto less tax efficient than other options, so keep good records and consult a tax pro. Risk? Crypto is very high risk. Prices can skyrocket or plummet overnight. Bitcoin and Ethereum are more stable than smaller altcoins, but even they're volatile. Scams are another danger since crypto isn't regulated. A hacked wallet or shady exchange can wipe you out. Security is as important as strategy. I only invest in established coins and store them offline for safety.